Hey, how's everybody from BiggerPockets doing? Dave Van Horn here from PPR Note Company, coming to you from sunny Philadelphia. Hopefully you can see me okay, hear me okay. Maybe you can give me a little shout out, let me know where you're chiming in from today. I know a week from today I'll be in sunny San Diego, so maybe some of you are joining me today from California or somewhere else, just as nice, hopefully. So, like I said, be sure to let me know, give me a shout out where you're coming from today. It'd be cool to see. So today's topic is probably one of the sexiest topics I know about notes, which is risk management, right? Really enticing. But before I get into that, this is all about how to get started in notes. And, think about it. What things can you do to get ready if you want to get into the note space and start buying notes? There's probably some things you can do to get ready. And just on the simplest level, I think you need to think about, how do I learn more about it, get educated, read up on it, read some books, listen to some podcasts like BiggerPockets, right? Obviously. But there's a lot of things you can do, and you can network with other people who are already doing the note business. So I think that's really important to think about, networking with folks, seeing other people's deals, shadowing other people's deals, those types of things. So there's a lot of things you can do to get ready to get into the note space and to learn more and more about notes. I know for me in the very beginning, some of the ways I started to learn about notes was through my hard money lender. I learned what his criteria was, that type of thing. And if you think about it, that's a short-term commercial note, right? So there's a lot of ways we can start to get into the note space just by reviewing things that we normally wouldn't think of. It could be anything from your credit card agreement is a note, right? So there's a lot of things we can do to practice and to get used to looking at notes that we're involved with. It could be an auto note to buy your cars, right? So a lot of people don't think about that it's a note, but there's a lot of things like student loans and the mortgage you currently have on your property that you might live in. You might never have thought to look at the documents again and review, hey, what is a note? What is a mortgage? Those types of things. Things you can do to get ready. So what we're going to cover today, obviously, is one of the four main parts of the note business, which we covered one last week. And just to give you a quick recap of the last Facebook Live was we covered administration, right? So there's four main parts of the note business, right? You have administration, risk management, borrower management, and exit strategies, right? So we covered a lot about administration last time, and we were going through some things like inbound and outbound administration. So on the inbound side, you're thinking of things like working with a servicer or utilizing, document management or reviewing the documents, making sure all the collateral's there, that type of thing. Setting up an account, whether you have a contact management system, those types of things. Working through your accounting on your file, getting all that in place. Now on the outbound side, could be things like recording your assignment, thinking about your contact campaigns with the borrower if you're working a non-performing note. Do you have a mail campaign, a phone campaign? Do you hire a skip tracer or door knock service? All those types of things come into play. Or do you hire a foreclosure attorney, and at what stage do you do that? And then of course you got all the tracking that goes along with that. So we talked about administering a note last, I guess the last call, which was was it last week? Well, we had the holiday. I think it was last week. So, we were covering a lot of the administration part and some of the tracking. Now, if you're buying a performing note, you might have that loan placed with a loan servicer, and they do all that for you, which is nice. Now, some people want to roll up their sleeves, get a little more down and dirty, so to speak, and actually work the loans themselves, right? So I don't know if you guys are just joining me. Let me see. Can I see who's... I see Edward from Brooklyn in the house. Actually, I was just up in Brooklyn not too long ago, a couple weeks back, and had a great time up there. Let me see who else. Jeremy, Tim's chiming in. So a lot of people are joining us right now, which is good. And I was just doing a quick recap of what we were talking about last time. Well, let me see who else we have joining us today. So this is great. So a lot of you are just getting started in notes. Some of you might be a little more experienced, but there's a lot of similarities between the note business and real estate investing in general. And I'm going to point to some of those similarities and differences periodically, just to kind of give people a better understanding of the note space, right? So we're talking about the four main parts of the note business, and maybe you're just joining us. And today we're going to cover part 2 of one of the four main parts of the note business, which is risk management. Now, risk management, you might say, well, how important is that? Well, it's pretty important if you don't want to lose your money, right? So, and there's certain precautions you can take. Hey, Steven, what's happening? Tio, I think I'm saying your name right. You guys are joining us. Michelle, Steven, Vince, there we go, from Australia. All right, Vince, it's pretty far away. That's the beauty of Facebook Live. I can talk to a lot of folks from a lot of places all at once, which is great, right? And of course, I'm in sunny Philadelphia, it's sunny, but it's hot and humid. But anyhow, today we're talking about risk management. And when it comes to properties and real estate, there's a lot of similarities to risk management with notes. So just think about real estate, right? We do a lot of things to mitigate risk, to limit risk. And any type of investor, if you think about it, there's risk to every investment. And even as like a fund manager, I'm a fund manager, one of my jobs is to mitigate risk. I manage risk, I try to mitigate it. Just think about, we have a loss mitigation department, right? We're trying to limit our exposure to negative things with our investments, right? So a lot of times we start out with things like entity selection, and it could be other forms of asset protection as well, right? Sometimes we, think about risk avoidance or risk protection, insurance against risks. A lot of times we'll have liability insurance on our properties, right? The homeowner's insurance, we'll have, we don't want anybody to slip and fall, so we have insurance in place, and that's to limit risk, right? Sometimes we'll have, for a general contractor, we might have workman's comp to protect us from a contractor getting hurt at one of our locations. Or we might have tenants have to have liability coverage to protect their contents or to protect their guests, those types of things. So there's different things we can do to mitigate risk. And then there's other strategies we utilize to just as well, which could be like setting aside some reserves, right? For a rainy day. What if something happens with my properties? The roof goes or the heater goes, or I might buy a property where I put a home warranty on the property, or I might do some due diligence. And I might have some inspections, right? So how many of us have hired a home inspector or a contractor to go out and look at a property or to look at a defect before we buy the property? We want to make sure, hey, we don't run into a bunch of hidden surprises, right? So these are all things we do in the real estate world to mitigate risk, to limit risk, that type of thing. Well, when it comes to loans, it's similar, right? First of all, there's a lot of things we want to do whenever we go to buy a note and mortgage. There's certain things we want to get clear on, right? We want to get clear on the documents. We talked about that last week with the administration. We want to get clear on the homeowner, right? And with the homeowner, we're kind of after borrower intent. What do we think this borrower wants to do? Do they want to stay? Do they want to go? Do they want to try to work things out? Are they ready to move on? Like all those things. Now, a lot of times we don't know that till we actually reach out to them, unless it's occupied. Then we kind of know they want to move on, right? Or they wouldn't have left. Also, we want to get clear on the property, the collateral behind the note and mortgage that we have, right? So we want to get clear on, all different kinds of things about the property. And then we want to try to get clear on what are some of the best exit strategies based on the data we have, based on the information. What's the most likelihood of something happening? Now, a lot of times it's not up to us in the note world. It's kind of up to what the borrower wants to do. And we kind of just help them along to do what it is they want to do. we don't, as we work through, especially in the non-performing note world, we almost doesn't matter what they do. We just we just kind of want them to make a decision to do something. That's really what it is. And then we kind of help them along, and hopefully it turns into a situation that's kind of a win-win for everybody involved. So hopefully if you're just joining us, we're talking about one of the 4 parts of the note business today, which is risk management is what we're talking about right now. And one of the key things, whether you're buying a property or whether you're buying a note and mortgage, is due diligence, right? And due diligence is something that I do cover in my latest book, Real Estate Note Investing, chapter 14. We talk about due diligence, and it's real important in the note space, right? You definitely want to do your homework and do some due diligence. And one of the first things that we look at is the status of the loan. So what do I mean by status of the loan? Well, first of all, is it a valid lien? What position is it in? There's been times when someone was trying to sell me, a second mortgage, and I found out it was a third mortgage. Or somebody said it was a first mortgage, and I found out it was a second mortgage. Or it was a second mortgage, and I found out it was a first mortgage. So a lot of times you want to trust the information, but you want to verify or validate the information that a seller is providing. You also want to know the note seller. How reputable are they? What's their reputation? Are they going to be easy to deal with? Are they a player in the business, or are they just some fly-by-night outfit? So you do want to know that. I'm sure you've heard the expression joker broker, right? Everybody wants to stay away from joker brokers, right? So you want to make sure who are you dealing with, check them out, vet your note seller, because that's important, right? But you want to know the status of the loan. What position is it in? And then what stage is it in? Is it current? Is it payments are current? Is it behind? How far behind? Those types of things. Is it delinquent? How many days is it delinquent? All that information is important, right? So you want to learn the status of the loan. You also want to know the condition of the property behind the loan. We also look into the geography and all that type of stuff, the neighborhood, the heat index, the school district, especially in first liens, right? We look at a lot of those things. And one of the things we do to mitigate some of that risk is we utilize boots on the ground, I call it. So whether that's a contractor, an inspector, our realtor, our property manager, we send people by, plus we do stuff electronically as well. So a lot of times, especially with first mortgages, we're interested in things like how much equity is protecting us. So we want to get a handle on the fair market value. Sometimes we'll send, a real estate agent by to give us a broker price opinion. What do they think it's worth from the outside? Now, I understand if it's occupied or you can't get inside, it's the next best thing to trying to get a handle on the value. Now, we can also run comparable properties in the neighborhood to try to get the after repaired value. So there's a missing link here, right? Especially if you don't get inside the property. And you know what that is? You don't know what kind of condition it's in, or you don't know how much work it needs. So that creates one of the challenges in the note space. But then again, that challenge is what creates the opportunity that enables us to buy loans at a discount. So, hey, James, nice to see you, and Baruch, I think, and Chris, and who else is joining us? Sean and Andy. Great to see you guys. If you're just joining in today, we're talking about risk management in our segment on how to get started in notes. It's kind of like, there's some things you can do to get ready to buy a note. Kind of what we're talking about right now is, okay, I bought a note, now what, right? And last Facebook Live, we were talking about the administrative part. Okay, I just bought a note. Now what do I got to do with everything? Today we're talking about risk management. And it's important to understand how do we manage the risk in the asset we bought, right? And we talked about, okay, in real estate we do it, and it's probably more common or more well known what to do. Hey, I know I need homeowners insurance, right? The bank's going to make me do that. And we do other things to mitigate problems, right? We want to avoid certain situations. We don't want any hazards at the property, right? We have smoke detectors. We do certain things. we're polite to the tenants. We don't want to antagonize them or whatever. So there's a lot of things you can do to mitigate risk. The biggest risk in owning real estate, for me anyway, was turnovers, was a vacancy, right? It wasn't so much some of the other things. It's like, a vacancy for any length of time could wipe out all the cash flow for the year, right? So to me, it was a vacancy was my biggest threat in most cases, Well, with loans, it can be similar, right? If people don't pay it, or you can't get the loan reperforming, or it drags out a long period of time, it can eat into, the money that you could make on a deal. So a lot of times there's different due diligence we can do, but a lot of it is determining, the condition of the asset that's backing the note and mortgage that we purchased, right? Another thing that we do besides trying to determine the equity and making sure that there's enough protection for us with the equity of the underlying collateral is we what's called an occupancy and encumbrance report, like an O&E report, which is, it's really like a quickie title report. It's where we find out that it's almost like a present owner search where we get the current liens against the property. Could be anything from homeowner association liens, municipal liens, IRS liens, mechanics liens, all those types of things. Sometimes we're also looking for bankruptcy information. We can check Pacer. Pacer is a website where we can check current bankruptcy status, if the borrower had filed bankruptcy or what stage of bankruptcy they might be in. All these things can be important in our due diligence, right? So, and of course taxes, right? There's even tax monitoring companies that'll monitor the taxes on the note and mortgage you own, and they'll actually alert you if someone's behind in their taxes, that type of thing. And, of course, we're looking at, is their homeowners paid? Sometimes there's an escrow account from that was paying the taxes and insurance up until the time you might have purchased it, that type of thing. So you want to see, what are the back taxes? Is there a pending tax sale? Those types of things. So also the accounting, right? We want to know the accounting on the note and mortgage. Especially like if I'm buying a junior lien, is the first mortgage being paid down or is it increasing? Which might mean they're not paying that loan, right? So we can learn a lot of these things by pulling credit. So there's a lot of due diligence we can do. Another thing we're interested in is occupancy. A lot of times occupancy could start to dictate the outcome of some of the deals. And with that, if it's vacant, right, we might be concerned about, property preservation. We could hire a property preservation company to go in. You'll see them use, plywood to board up the house, or the clear plastic now, which is definitely more appealing to neighbors. You might want to winterize the property, change the locks, protect the asset, right? Make sure there's no holes in the roof or something like that. Sometimes we can actually get some repair estimates going and find out what that looks like, as we're approaching the foreclosure sale with the loan, or, these are all different things that can lend to our strategy on the exit side. So, and then the next piece I start to think about is the foreclosure matrix, I call it, the timelines of foreclosure in the particular state that the asset's in, and the county too sometimes. Because a lot of times there's different timelines and cost from different states, right? So I'll give you an example. Texas is a quick state. Foreclosure costs they're usually lower in deed of trust states than judicial states. Then I go into a state next to me, which is New Jersey or New York, and foreclosure timelines are pretty long, right? Costs are pretty expensive in New York, for example. And some states have a long ejectment time period even after foreclosure. I think of Delaware. Delaware has like a 6-month ejectment after the foreclosure. And then there's some states that fool you. I think of Alabama. Alabama has a quick foreclosure because it's a deed of trust state, but then it has like a 1-year redemption. So, hey, that's still going to hold you up, right? So a lot of people, might not know I call it the foreclosure timeline and cost matrix, so to speak. What's the rules of the road in the particular area where you bought your note and mortgage? And it doesn't mean don't buy there. I've had notes and mortgages all over the country. It's just you want to be aware of it. what's it going to cost me? How long is it going to take if I stay on top of this deal? The other thing that we consider is market conditions, right? A lot of times I'm checking with local realtors or multiple listing systems to say, hey, what is the days on the market to sell a property? What's the market rent? Because a lot of times a rental is my worst case scenario. So I want to know what that looks like. You want to know if I have to rent this property out because I can't sell it, what kind of rent can I get? And the other thing is the geography, right? And I mentioned heat index. Heat index is something, I think it's on Trulia, you can find the heat index, which is like, what's the crime rate in the neighborhood, or the schools, or the walkability score. I know David Green covers a lot of this in his book, Out of State Investing, which is a great book if you're going to invest in notes and mortgages out of state. Don't tell David Green I said that. But it is a great book because it's about managing a property. What if you take a property back in another part of the country? How do you manage that? And his book's great for that. A lot of great strategies on how to do that. But it's it comes back to this REO disposition. REO stands for real estate owned, and that's when a bank takes a property back at the foreclosure sale, and now they own it. The foreclosure's done. The note and mortgage are kind of go away, and now they own the property. They end up with a sheriff's deed, and now they're the owner of the property, and they have to liquidate. Usually they'll liquidate the property. They could fix and flip it, they could fix and rent it, or they could just sell to a wholesaler. Most banks are just cleaning out the property, just like we do at PPR. Is we would, most of the time we're cleaning out the property and selling it off to a real estate investor or a wholesaler, those types of things. So I don't know if anybody, let me see if Grand Rapids is in the house. I don't know if anybody has any questions. I'm trying to see if anybody, hold on. It's a little tough on the screen. This one I can't really see. Careful with general contractors, depends on your capital. Some people are saying, nice job. What town are you in? I am in Philadelphia. Or they're asking somebody else that. Maybe they are. Let me see. Anybody else have any questions here? But anyhow, so we're talking about risk management. We're talking about how to deal with, due diligence, looking at a property. All these are great ideas you want to definitely be aware of before you, sometimes before you buy the property, but a lot of times you can manage certain risks that you find out after you get the property. Especially with first mortgages, a lot of times when I own the note and mortgage, there's this timeline. And there's a timeline before I get to foreclosure, then there's the foreclosure sale day, and then there's post-foreclosure. So a lot of times there's different data and information I collect along the way on that timeline. In the very beginning at acquisition, I might have a limited amount of data. I do the best I can, but for example, I might not be able to get inside the property, especially if it's occupied. I won't know how much work it really needs. Now, I could tell some things from the outside. I can do all kinds of due diligence in the multiple listing system. I can talk to realtors. I can find out comparable properties. Because think about it, the comparable properties is going to give me the after repaired value. Now, I could send somebody by to try to get an as-is value as best I can. And then I can kind of start to make decisions. Now, once I get to the foreclosure sale, or even just before it, if they move out, I can secure the property, protect my asset. I can send a property preservation company or change the locks, especially if they've abandoned the property. And then a lot of times when I get inside, I can tell what it needs. Now, if I know that before the sale, it could influence my bidding instructions to my law firm about what I want to, what the bidding instructions are at the sale. And I might want to let it go at sale if it's a situation that might, be better for us than it would be to keep the asset post-sale and work through the property, whether that's cleaning it out and just selling it or fixing it and flipping it. Sometimes we sell it to a wholesaler, sometimes we sell it through a retail situation. So all of the above. So how would you value a property in mid-construction? Well, that's easy enough. I mean, I think you can tell mid-construction, you can see what's left, are the major systems are in. I worked in construction for, believe it or not, 22 years. So you can tell by certain certifications and permits that are pulled. You can see how far they are. Are the rough-ins done? Are the walls closed up? So there's certain inspections and things that need to be done prior to that. Does your book have step-by-step when doing due diligence and how to evaluate residential properties? Not so much. It does go into due diligence on notes a little bit. But there's plenty of people that talk about that and teach that. How can you tell if a market is oversaturated? Well, that's a good point. I mean, days on the market tells you a lot. Population growth tells you a lot. The economy tells you a lot. You can kind of get a sense of what's going on in an economy. Are jobs improving or are jobs leaving? That's a great question. I mean, what's the economy like in the area where you're buying the loan? Now, I often tell people, the biggest risk in the note business is you. And they're taken aback by that at first when I say that. And they go, why do you say that? Well, it's because usually you don't have enough capital deployed into the marketplace, right? If you own one loan and the loan defaults, you have a 100% default rate. If you have 10 loans and one loan defaults, you have a 10% default rate. If you have 100 loans and one defaults, you have a 1% default rate. So you see where I'm going with this. Why do you think big banks have millions of loans all scattered in every state? And it's because they're spreading their risk around. So a lot of times the reason we have so much risk is we only own one asset, and all our eggs are in one basket. And really that's what's creating the risk. So a lot of times the risk is us. So anyhow, let me see. These are some great points. I think if you're just starting out, you do want to, try to mitigate your risk. You can mitigate your risk if you get a deal with a lot of equity, for example, or you get a deal where there's, the property's in good condition. Do you want a mobile home that's fallen off a cliff? No. We've had boots on the ground go out and look at a tape of properties and call us back and say, hey, that property's no longer there. It was bulldozed in I think it was like in Cleveland, hey, they bulldozed that. That's gone. So, good thing we didn't buy that one, right? So you got to do your due diligence. A lot of times that involves boots on the ground. You want to send people out to the property and hopefully mitigate your risk. So hopefully you guys like what I'm talking about today. If you do, give me some likes, some thumbs up, some comments would be nice. Maybe a review, share. All that's good. Hopefully you enjoy some of this stuff. Like I said, if you have any questions or I didn't get to you today, by all means ask a question. I do go back and answer them or ask them in the forums, or feel free to private message me on BiggerPockets. But I do have some good news that is along the same lines. We're actually going to be covering part 3, borrower management, which will be on September 19th. I'll be back at you on another Facebook Live, same time, same channel, 6 p.m. Eastern, 4 p.m. Mountain, so it depends where you're at. If you're in Australia, I have no idea what time zone you're in. That's up to you. Hopefully it's not in the middle of the night for you. Also, I did want to let you guys know I have a note investor Q&A, which is a question and answer call on September 18th at 8 p.m. Eastern. And I actually have a special guest, Kevin Ernest, and Kevin's from Anders Capital, and he's going to be talking about REO disposition. What's cool about that is I'll be interviewing Kevin and talking to him about how, he has a company that is, they specialize in disposing of REO property. He was, worked at a bank previously, worked in their REO department, as well as has a company that works with REOs regularly, and they also have, financing vehicles too, whether it's, business lines of credit for wholesalers that are renovating lots of properties. He can talk to you a little bit about the rehab financing side of things as well. But he's a great interview if you're around 8 p.m. Eastern time on September 18th. If you want to go to ppr.noteco.com, you can actually register for that call. It is capped at 1,000 people, so if you want to get on the call, by all means, register. We do those calls periodically every now and then, and they're great. After the interview, you can actually ask questions of Kevin, and then me and my partner, Bob, who is our manager of our loss mitigation department, we actually get in deep with note deals. So if you have a note deal you're working on, you have questions, you don't know what to do with your note, you're at a standstill with your note, you have questions of how to handle your attorney, all these different kinds of things that come up with owning a note, especially non-performing notes. By all means, this might be the call for you. You want to get on there or listen in. You can learn a lot. And the beauty of that is you get somebody with like over 10 years of loss mitigation experience to answer any of your questions on your note deal. And then of course, we cover general questions as well if there's time permitting on that night. So September 18th, 8 p.m. Eastern. If you go to pprnoteco.com, you can register for the Note Investor Q&A call. And last but not least, if you haven't picked up a copy of Real Estate Note Investing, by all means, I recommend trying to get a copy. If you want the discount code, 20% off, it's Live Note Investing. Live Note Investing, all one word. Get you 20% off the book at BiggerPockets. It also has a couple bonuses on there. There's an ebook, Stay Safe, that kind of self-explanatory, sort of like what we're talking about today. There's also a video with Brandon Turner that me and my partner Bob do, where we actually go out to a couple websites. I believe it was FCI Exchange, and we look at different notes to purchase, things that we look at: first mortgages, second mortgages, performing mortgages, non-performing mortgages, and we actually walk through some of the due diligence we do. It's a pretty cool video. Excuse me. You can definitely pick up some pointers on that as the things that we like to look at. And last but not least, the last bonus is Avoiding Investor Mistakes with attorney Mary Hart, who is an asset protection attorney, great friend of mine. She does a great job on an interview of some things you can do to stay safe in the business. So hopefully you guys enjoyed today's call. By all means, if you have any questions, you can private message me or leave a message, and I'll definitely get back to you and answer you. And like I said, hope to see you next Wednesday, which would be the night. You know what? It's not next Wednesday. I'll be in San Diego. It's the Wednesday after that, September 19th, same time, 6 p.m., Facebook Live, and we'll be talking about how to get started in notes. So thanks, guys. Thanks for joining me today. Hope you enjoyed it.